When big banks and investment companies use computers to make automated high-speed trades or shady derivatives or default swaps, they get off scot-free. They don't pay anything. Last night, 11 members of the European Union voted to level the playing field by putting a transaction tax on their markets. That's right. BBC reports the tax is expected to be charged at a rate of 0.1% of the value of any trade in shares or bonds and 0.01% of any financial derivative contract. Now, the 11 European countries feel this tax will discourage risky trading and add billions of dollars to the struggling economies. Senator Tom Harkin of Iowa and Congressman Peter DeFazio of Oregon have been trying to get a similar transaction tax passed in America for years. The proposal would put 3-cent tax on every $100 of stock, bond, or derivatives transactions. Those 3 pennies add up. Harkin says a transaction tax would generate $352 billion in 10 years. Not chump change. Think about it for a second. Here's 520s. There's $100. Visualize this. There's $100, okay? Every time there's 100, there's 3 cents. Well, I better get my piggy bank out here. Just like that. That's it. That's it. $100, 3 cents. There you have it. What could we do with $352 billion? Do you think maybe we could pay for at least one of the wars? Or do you think maybe we could insure maybe another 30 million people? Do the math, that would pay for about half of Obamacare. That would really make the righties happy. But think about it. Why is it that, number one, Wall Street doesn't get prosecuted? Number two, they get off scot-free on these transactions. This is an easy thing, and nobody's going to feel it. Everything's going to be fine. Joining me tonight, David K. Johnson, Pulitzer Prize-winning journalist and author of The Fine Print. David K., great to have you with us.
Good to be here.
Explain what a high-speed trade is for those who aren't in that fast lane.
Almost all the trading done today is done with computers that spot prices, changes in the market, and execute trades. 2.9 billion trades a day just on the New York Stock Exchange. There were 40 million a day roughly 30 years ago.
What would we do with $352 billion over 10 years?
Well, let's see. If you're worried about the deficit, the Republicans keep worrying about that. It would help bring it down. It would help us finance, as you pointed out, the Affordable Care Act. There are a lot of things we could do with it that would benefit society in ways that these high-speed trades do not.
A study by the CFTC shows the average aggressive high-speed trader made a daily profit of $45,267 in a month in 2010. That's some serious coin. How would this tax hurt them?
Well, the trading that they're talking about is speculation. We have a Wall Street market to marshal capital and make for efficient use of that capital to invest in factories and research and create jobs. But the investors who do that are being pushed out and made irrelevant by the speculators using borrowed money who account for almost all the trades. So what would happen is speculators like that would see their costs go up a little bit. They'd be less likely to trade. We'd have a more efficient market and fewer distortions for people who are investors rather than speculators.
Do you think that it would discourage the risky trading? Because this is what they're saying in the European Union, that this is one of the reasons why they passed it.
Well, there's an old saying, if you tax something, you'll get less of it, and that's exactly what this is designed to do. It is intended to discourage these high-speed speculative trades that are distorting the markets, making the markets less economically efficient. Now, Wall Street will come back and say, there are studies showing that this will make the market worse, and those studies are based on more than 20 years ago before we had these high-speed computer trades.
Is there any downside to a transaction tax?
Yeah, if you're a hedge fund manager or one of these high-speed traders, you're going to actually have to pay some tax, and it's going to discourage you from making bets that distort the market. Now, but for the rest of us, I don't see a downside in it.
How would we make a determination? Because you know that they would come back and say, oh, this is really going to hurt the economy. How would this hurt the economy?
I don't see how discouraging speculation, which is almost all done with borrowed money, the effectively borrowed money at a rate of 30 to 1. So you put 3% down and borrow the rest of the money. I don't see how this hurts the economy. And if we reduce this volatility and reduce market distortion, we can get back to having a market focused on investments that create production in the future and wealth in the future, not creaming the market today through speculation.
Quickly, you think this is something Congress could embrace?
Not probably in this Congress, in the House, but I think this is an idea. It's been around for 80 years. We may well see come about, Ed, and hopefully we will. We need speculators, but we don't want them to be overwhelming the market.
All right. David K. Johnson, thanks for your time tonight on The Ed Show.